Hi, and welcome back to the channel. Today we're talking about an economic tool that packs a lot of power, but let's be honest, is pretty confusing. Quantitative easing. Or as the cool kids call it, QE. Is it genius? Is it madness? Or is there something more going on behind the scenes? Stick around, and by the end of this video, you'll have a better grasp on the economy than most of your friends. Let's get into it. Alright, so what is QE? It is a monetary policy in which a central bank, like the US Federal Reserve, purchases securities in the open market to reduce interest rates and increase the money supply. But how does it work? They can't just print cash out of thin air, though it sometimes feels like that. Instead, they have to buy financial assets like government bonds from banks, putting money into the financial system. This lowers interest rates, making it easier for you, me, and businesses to borrow money. Lower rates mean more borrowing, more spending, and possibly a kickstart for the economy. But wait. Before you get too excited about easy money, let's talk about the consequences. QE sounds pretty great in theory, right? More money for banks, cheaper loans for us, and a boost for the economy. But like with everything, there's a catch. On the plus side, we're told QE helps stop financial crises in their tracks. Think 2008 or 2020. Without it, it's thought things could have been a lot worse. But the downside? It can also fuel inflation, which means the price of everything, food, housing, gas, goes up. When too much money is floating around, its value starts to drop. The more dollars out there, the less each one is worth. So yeah, that loan you got might be cheaper, but you could be paying way more at the checkout line. So, we've just discussed the official information about QE, but this is where things get a bit spicy. Some think it isn't just an economic tool. They think it's part of a much bigger, darker agenda. Yep, you guessed it. It's conspiracy time. One of the big theories? QE is part of a plan to devalue the dollar and create a new global currency controlled by, well, who knows? The global elite, lizard people, the Illuminati. Pick your flavor. According to this theory, central banks are secretly devaluing currencies to set the stage for a new world order. Another popular idea is that QE is a way to make the rich even richer. Here's the logic. When central banks pump money into the economy, it often ends up inflating the prices of assets like stocks, property, and bonds. And who owns most of those? Yep, the wealthy. So, while we get cheaper loans, the rich get even richer as their assets soar in value. Is QE just a clever way to keep the elite on top? Or is that just paranoid talk? I'll leave that for you to decide. Okay, so conspiracy theories aside, what does QE actually mean for you? First off, if you've been enjoying lower interest rates on mortgages, car loans, or credit cards, you've got QE to thank for that. With central banks keeping borrowing costs low, it's cheaper to finance big purchases. But remember, there's a flip side. If QE leads to inflation, those everyday costs like groceries, gas, healthcare, might be on the rise. It's a bit of a balancing act. Lower interest rates can be great, but inflation eats away at your purchasing power. Quantitative easing might sound like some far-off concept, but it's been used multiple times in recent history to rescue economies from the brink of disaster. Let's take a look at some real-world examples of when QE was deployed. First up, the 2008 financial crisis. Remember when the global economy nearly fell off a cliff? Yeah, that was a scary time. The US Federal Reserve stepped in with its first major round of QE, purchasing over $1 trillion worth of mortgage-backed securities and government bonds. The goal? To stabilize banks, lower interest rates, and get people spending again. And, believe it or not, it worked. Though we're still feeling the aftershocks today. Next, the Eurozone debt crisis around 2010. Countries like Greece, Portugal, and Spain were drowning in debt, and the European Central Bank, ECB, launched its own version of QE. They bought massive amounts of government bonds from struggling countries to keep the euro afloat and prevent a financial collapse. This helped keep countries solvent, but it also brought austerity measures, which were less popular with the public. And did you know Japan has been using QE way before the rest of the world caught on? Back in the early 2000s, Japan's economy was stuck in what they called the lost decade. The country's central bank launched QE to fight deflation and stimulate growth. They bought government bonds and flooded the financial system with money. Even though it helped stabilize things, Japan still faces economic challenges today, and QE hasn't completely solved their problems. Then there's the Bank of England. In 2016, after the shocking Brexit vote, economic uncertainty gripped the UK. To prevent the economy from crashing, the Bank of England turned to QE, buying billions of pounds of government bonds to calm markets and reassure investors. While it helped ease the immediate panic, the long-term consequences of Brexit and QE remain to be seen. And of course, who can forget 2020? When the global pandemic hit, economies around the world were forced into lockdown. The US Fed didn't waste any time, rolling out one of the most aggressive QE programs ever seen, buying trillions of dollars in bonds, mortgages, and even corporate debt to keep the economy alive while everything else ground to a halt. In each of these cases, QE was the central bank's tool of choice to fend off total economic meltdown. But as we mentioned earlier, it's not a perfect solution. While it helped avoid immediate disaster, the long-term effects, like rising debt levels and inflation, are still a major concern. Now the big question on everyone's mind: how long can central banks keep using QE? Since 2008, the Fed has rolled out QE several times, most recently during the pandemic. But there's only so much they can do before the consequences start catching up. Many economists worry that we might be building up a debt bubble, or worse, that inflation could spiral out of control. The longer we rely on QE to prop up the economy, the riskier it gets. But on the flip side, if we stop QE too soon, it could slow down economic recovery. It's like a high-stakes game of Jenga, and no one wants to be the one to pull out the wrong block. To wrap things up, quantitative easing is like any powerful tool. It can do a lot of good, but it comes with risks. Without it, the economy could have crashed hard after 2008 and during the recent pandemic. But if we rely on it too much, we might end up with runaway inflation or a financial bubble that's ready to burst. Whether QE is a brilliant economic strategy or a ticking time bomb, one thing's for sure: it's shaping the future of our money. So, what do you think? Is QE a necessary evil, or are we playing with fire? Drop your thoughts in the comments below. If you liked this breakdown of quantitative easing, make sure to hit that like button, subscribe, and ring that notification bell so you don't miss any future videos on the crazy world of finance. And who knows, maybe next time someone brings up QE at a party, you'll be the one explaining it. Stay savvy, my friends. I bet you didn't know managing money could be this easy. Subscribe now and get the latest finance tips and tricks straight to your feed. From saving smarter to investing better, we've got you covered. Don't miss out. Hit that subscribe button today.